Hey everyone, and welcome to This Explainer. Today we're unpacking a really vital piece of the puzzle, a cooperative's general reserve fund. We're going to discover exactly how this fund acts like a giant financial shock absorber when the unexpected strikes, literally saving cooperatives from going under. If you're involved in cooperative management, finance, or honestly just wanting to understand how your organization stays afloat, you're absolutely in the right place.
So, picture this. It's a looming, incredibly stressful question for any board member or financial officer. What exactly happens when operating expenses outweigh income, or out of nowhere, a disaster strikes? Every business faces bad years. Crops fail, prices drop, equipment breaks. But in a cooperative structure, how do we handle a deficit on the books without completely destroying the equity that our members have worked so incredibly hard to build? Well, that is exactly what we're going to solve today.
To answer that, we'll be covering 5 key areas on our agenda: meet the reserve fund, fixing a simple loss, handling partial coverage, surviving a disaster, and finally, the visual effects on equity. Let's get right into it. Starting with Section 1, Meet the Reserve Fund. Before we look at the math, let's establish our 2 key players. Think of the undivided net surplus as your daily operational temperature. It constantly fluctuates, right? In a good year, it's positive. In a bad year, it drops into a deficit. The General Reserve Fund, or GRF, on the other hand, is your heavy-duty thermal blanket. It's a legally mandated, built-in financial safety net that just sits there on your balance sheet, specifically designed to absorb those deficits when the temperature drops below freezing. It's basically accumulated over the good years precisely to protect you in the bad ones. Let's move on to Section 2, Fixing a Simple Loss. All right, let's look at a common operational hurdle. Here we have Green Harvest Coop. Now, due to low pallet prices in the market and unusually high operating expenses this season, Green Harvest is facing a net loss of 50,000 pesos. Normally, a 50,000 peso loss would be a massive headache. But thankfully, because they've had really good management in the past, they have a healthy 200,000 pesos sitting safely in their general reserve fund.
So how do we actually fix this on paper? The accounting requires 2 super simple logical steps. First, during our year-end closing, we officially recognize the loss. This means recording that our undivided net surplus has gone negative by 50,000 pesos. It officially becomes a deficit. Second, once the board of the General Assembly approves it, we utilize the GRF to cover that loss. We just transfer the funds to eliminate the deficit entirely. And to actually make this happen, the textbook journal entry is pretty straightforward. We simply debit the General Reserve Fund for 50,000 pesos, which reduces its balance, and we credit the undivided net surplus for 50,000 pesos. That credit perfectly cancels out the 50,000 peso deficit we just recognized. It just balances out beautifully.
The crucial point here is the aftermath, which is frankly brilliant. Yes, our general reserve fund decreases from 200,000 to 150,000 pesos, but the operational deficit is now 0. The cooperative's overall financial position is completely restored. And most importantly, the share capital, the actual money the members invested, remains completely untouched. The cooperative can literally wake up the next day and continue normal operations without skipping a beat.
All right, Section 3, Handling Partial Coverage. Let's raise the stakes a bit. What happens when the safety net isn't quite big enough to catch the entire fall? Imagine a truly severe year where everything goes wrong and the cooperative suffers a massive net loss of 120,000 pesos. That is a heavy, heavy operational hit.
The tension really mounts here because, looking at the books, the available general reserve fund is sitting at only 80,000 pesos. The math is pretty clear. The deficit is bigger than the safety net. So what does the accounting actually dictate we do?
Well, the golden rule is that we can only drain the general reserve fund down to 0. We absolutely cannot have a negative reserve. So we make our entry to debit the maximum available 80,000 pesos from the reserve fund to absorb as much of the blow as possible, and we credit the undivided net surplus for that exact same 80,000 pesos. So the shock absorber took most of the hit, draining itself entirely in the process. However, because the loss was 120,000 and the coverage was only 80,000, the cooperative is left with a lingering 40,000 peso deficit. And this remaining deficit doesn't just magically disappear. It has to be carried forward on the books. The cooperative is going to have to earn their way out of it, covering it with future operational surpluses in the coming years. It's a stark reminder of why building up that reserve during the good years is absolutely crucial.
Let's tackle Section 4, Surviving a Disaster.
Now let's look at a much more dramatic scenario, an unexpected, sudden catastrophe. Picture this.
A fisheries cooperative has just brought in a massive haul, but overnight, a severe power outage strikes the facility. The freezers fail. By morning, they have lost 70,000 pesos worth of fish inventory to spoilage. It is a devastating, sudden blow. But fortunately, they have a healthy 150,000 pesos in their general reserve fund ready to deploy.
Because this isn't just a standard year-end operational shortfall, the accounting here requires 3 specific steps. First, we must specifically recognize the spoilage loss directly against the inventory. Second, at year-end, we close that loss out to create our 70,000 peso deficit. And finally, step 3, we trigger the reserve fund to clear it.
This first critical entry directly addresses the sudden tragedy. We debit loss on spoilage for 70,000 pesos, and we credit inventory for 70,000 pesos. This takes the value out of the physical inventory on the books and officially logs it as a specific recognized disaster loss. After this, steps 2 and 3 proceed exactly like our first scenario, closing it to a deficit and then draining 70,000 from the GRF to wipe that deficit clean. The outcome here is phenomenal. Because the General Reserve Fund was healthy enough, sitting at 150,000 pesos, it immediately absorbed this massive 70,000 peso shock. They even have 80,000 left over in the reserve for future issues. A disaster that could have easily bankrupted the cooperative and ruined its members instead becomes a totally manageable bump in the road. The cooperative seamlessly continues its daily operations.
Okay, final section. Section 5, the visual effect on equity.
To truly appreciate the power of these accounting entries, we need to think about the visual effect they have on the cooperative's equity books. Before we trigger the reserve, the financial books look quite alarming. The General Reserve Fund sits comfortably at $200,000, but right below it, you've got that 50,000 peso deficit glaring from the undivided net surplus line, dragging down the total equity. It's a pretty precarious position.
But by making that legal, approved transfer of funds, we instantly wipe out the deficit. The undivided net surplus goes from a negative 50,000 straight to 0. Yes, we sacrifice 50,000 from our reserve savings, dropping it to 150,000, but we completely stabilize the ship in the process.
If there's one thing you take away from this explainer, it's that the General Reserve Fund is not just idle cash. It is the ultimate financial shock absorber. Whether a cooperative faces a minor drop in crop prices, rising operational expenses, or a catastrophic power outage that ruins inventory, this built-in safety net is exactly what protects the members' core capital. It is literally what keeps a cooperative breathing during its hardest days. So knowing that a deficit is always a possibility in any business, you have to look at your own organization and ask yourself, how healthy is your cooperative's reserve fund? Have you been proactively building it up during the profitable seasons? Because when the next storm inevitably hits, you will want to make sure your financial shock absorber is robust enough to catch you when you fall. Thank you so much for joining me on this explainer. Keep learning, and I'll catch you in the next one.